Welcome to Advice from the Deal Room. I'm Ben Record.
Matt Russell.
And today we're going to talk a little bit more about kind of just a little economic update, kind of tell you guys what we're seeing in the market, what we're seeing from the news side of things, and what the next couple months might bring.
Lots of movement again, guys. Lots of things going on. Reports came out a little bit better than expected from an inflation perspective, but a lot of that is the timing of what was going on during that month and that period. So inflation dropped, the headline numbers dropped from 4.2 to 3.5%. So, hey, inflation is going down. Everything's looking good. But you got to remember what was going on during that time period. In June, we were getting to a ceasefire. There was less geopolitical landscape going. The geopolitical landscape was better with Iran. So things were starting to free up during the month of June. However, things have changed, and that's a big driver of inflation, of driving down some prices. That is actually what is driving that. But then you look at July, what's happened since, and we're back to consistent war, consistent bombing over there. And that is being reflected out there in the Treasury market and higher rates than what we're expecting. So there's a lot of up and down. And this makes the Fed's job a little harder to look at when they're saying, last month's numbers printed low. Numbers look good. They're headed back down in the direction that we're getting back down to that 2% that we want. Instead of the double that in May, we're getting down to 3.5%. That's a big drop, a bigger drop than they're anticipating. But you got to think about what that actually does. That was then, now it's now. And the Fed's meeting here soon.
They're meeting, and next week, or when this podcast drops for all of you guys, the Fed is going to be meeting today, and they're going to be talking about whether they have a rate drop or a rate hike or what the forecast looks like. But they're making those decisions off of data that we already know is probably skewed in the wrong direction, showing that inflation dropped, but it's went back up in the month of July based on the war and the bombings and all the gas prices going right back up. So,
how much energy and fuel drives the majority of inflation? How do all of our goods get delivered to us? What does oil and fuel get put into products? And where do we, you got to think about what actually is the driver behind that. Is the transportation is a huge thing. So when oil prices spike back up, obviously inflation will go back up with it. Even if you scrap out the fuel prices increases, it still impacts the everyday products because of the transportation behind those products. And this puts the Fed into an interesting, they're pigeonholed in a corner. We saw last month looked good. Things aren't looking good this month. And yes, they don't have the inflation numbers from July when they meet because they're meeting in July, right? But every conventional wisdom will tell you that we're probably going to see a spike in inflation in the month of July because of what's happening out there in the geopolitical landscape and the continued bombing in Iran. What's that do to rates? I mean, I've read some predictions out there that we'll be at the same rates in the next year or two where we're at today. So everybody's expecting this big drop in rates, getting maybe a little bit of relief and comfort there. It doesn't look like it's going to be happening.
And it doesn't look like there's really any reasoning for property prices to soften too much across the board either, just because of, like you're saying, the cost of materials and everything is still expensive. So it's not like your cost to build anything is going to go down, which is generally what happens when rates stay high. You expect that property values move down a little bit, but that's not what we're seeing on the big picture.
They're probably going to increase rates. We'll see what happens later this year. I'm not going to say this month, but later this year is still going to be on the table for them to increase some rates. What's that do to the everyday consumer? The impact is going to be more related back to credit cards. It's going to be related back to even any consumer debt. And on the business side of things, the impact is going to be operating lines of credit. Most commercial real estate deals are not priced off of the Fed funds rate. The market is a little bit more, stable out there for that. The market's a better predictor of the 5 and 10 year, understanding that you're not going to, when the Fed does change rates up or down, you're not going to see any big impact to your commercial real estate deals because it's already being priced in. They already understand the dynamics, what's going on in the marketplace to price that 5 and 10-year Treasury, which I know will have some people maybe comment, well, our loan's priced off of the Federal Home Loan Bank. Well, that's what drives the Federal Home Loan Bank rates too, is the U.S. Treasury. So looking at that marketplace, you got to watch to see what happens there. So your operating lines of credit or your SBA variable rate loans will be impacted. Those are some of the loans that are going to be impacted. That's the majority of the loans that are going to be impacted is operating lines of credit, credit cards, and variable rate loans that are tied to prime, which are primarily SBA 7A loans or construction loans out there. Construction loans tied to prime plus a margin. You're going to have an increase on that too if the Fed does what people are anticipating, maybe an increase later this year. There's just so many moving parts right now for us to gather a hold of and go, what's going to happen? Well, maybe the war finally does get done. Maybe we get through this. And maybe by the end of the year, things get better. Nobody knows. And I don't think anybody that's pulling the triggers on these things and making the decisions know what's going to happen either.
No, and everyone's trying to pretend like they can be the soothsayer and they can see the future, know where it's all going. But half the time lenders are just adding in more margin because they don't know where things are going. So they're just trying to cover their bottom line by having a little bit wider margins at times too. So that's where even if it drops some, you don't necessarily see that immediate drop in rates a lot of times because lenders, like Matt said, have already priced it in and they're increasing their margin in those swings because they know it's probably going to go back the other direction the other way.
The best thing you can do in a time like this is look to see, do you have flexibility? Making sure you're set up for the flexibility that you need in your short-term and long-term goals. And this means making sure you have enough operating capital to survive these ups and downs. And if there's any ups and downs on your pricing on your operating line of credit that you're using, make sure you could sustain higher rates. Are you okay with that? Do you need to start managing your cash a little bit different? That's probably the one area that a lot of people got to focus on is that. If you're already in an SBA loan, look to see what the impact would be to you. If rates went up 25 basis points, 50 basis points, what did your payment do? It might not be as drastic as you think it is, but running that, understanding that is your best call to understand what your impact will be. And remember, those change on a quarterly basis. So if Fed funds moves, let's just say August, you're not going to get a reprice until October. But understand, well, my payment might go up, $1,000 a month. Probably not, but, just, $100, $200 a month.
Worst case, yeah.
What's this look like? Have you planned for that? Planning, flexibility, understanding what your path forward and having a plan to have exit ramps at different scenarios going forward. So you're not just going, well, this is what's going to happen. Rates will come down. And if they don't, or if they go up, have you planned and have you thought that through and how you're operating of your business, how it impacts your real estate loans you have? Do you need a refinance coming up? What are you looking at over those kind of things? But the Fed funds rate, like I said, is not going to impact most of your real estate deals on the pricing. They're still looking at the pricing's already built into. They're looking at long-term inflation. That's where the 5 and 10-year Treasury come into play. The markets are going, oh man, it's not like it's getting better. So rates got to be at this higher rate because they want a risk-free rate. When you look at the Treasury, people go, I need my risk-free rate. Then you add on, I need to take into consideration inflation. I need to make sure I capture that inflation back. If inflation is going to be long and high, it's going to be long-standing high, you need to make sure you're getting a return for that. You're not going to put your money in a 10-year thing and all of a sudden inflation continues to spike and all of a sudden now inflation is outpacing the bond rate you have. You want to take those things into consideration. That's when the market takes that.
Going on a little bit just of where rates are at and let you talk about having exit strategies. I think that's where it's so important right now is that you may have your ideal exit plan or your whole strategy for your deal, but having the what if scenarios planned out a little bit of other backups, other exit strategies, making sure that you know what you're you're going to be able to survive with and what you're going to need to potentially cut the deal with, because sometimes deals that made sense with the rates kind of in a stable rate environment don't make sense in this up and down rate environment that we're in right now, especially on the long term. Thinking of what we talked about last week and why there's an increase in people looking for DSCR loans is because of the operating the cash flow you're making on properties just isn't really achievable at a 1.25 debt service that you need for bank rates. Whereas with debt service coverage loan or DSCR loan, you can go a little bit lower debt service. So it allows you to make it work. But like we talked about last week, that puts you in a little bit of a pickle if things go bad or you're a little tighter than you had even planned on that conservative model.
In today's marketplace, I really like optionality, flexibility, and planning ahead more than you have before in the past. When rates are really low, lock it in really low, less planning to worry about. When rates are volatile and we have a volatile economic landscape in front of us, make sure you're building out your models to take that into consideration. Are you going to be able to withstand a 10% decrease in revenue, a 5% increase in cost of goods sold? What does this impact your business model? Are you going to be able to pass on some of those costs to the consumers? Or are you going to have to eat some of this? Looking at those different scenarios helps you understand the impact and helps you move those financial levers. Working with your CPA, working with an outsourced CFO, those are great things to do if you're a highly operating business, right? Got a lot of operations going on. You need to understand the influx in those different things. How's that going to impact you? So if you're in the real estate game, still just modeling it out and running some scenarios past your trusted advisors, and hopefully we're one of those trusted advisors. What's the impact to me here? How can I sustain this going through this? Because what happens if we get into an economic downslide, rents will come down because people need to still fulfill their things. So people start sliding rents down to get those tenants to move in, which means market rents will potentially slide down. Understanding that impact to your your rental property, understanding the overall local economy that you're focused in. This is not just a national thing. You got to really focus down to the local economy, the regional economy, and how that's impacting you and your rental income. We could be in a part of the economy that's great. Over here in one market, national economy is going to shit and hell in a handbasket, right? But you're still softened and you're cushioned a little bit. You might be able to get through that better with market rents than you would in other markets where market rents will start declining because people's behaviors change. And, I'm seeing in some markets right now where there's so much inventory coming online. So people are paying market rent to live there by getting 2 and up to 3 months free. So is that really market rent that you're receiving, or you're just hiding it through concessions? And cool, you get these concessions to get them to move in, but you got to give concessions for them to renew their lease. So is that really market rent? So you got to take all those little factors into play. Look at the economy, supply, demand. There's so many factors that comes into play here. And you can't just sit on it and forget it sometimes. You've got to actively manage your properties and your business through times like this. And there are opportunities for people to take advantage of a downturn.
And there's a lot of properties that have been mismanaged by their owners for so long that they can't sell or can't work in the current market without someone coming in, buying them for a little cheaper, for doing the move up and being a little aggressive to renovate a property that hasn't been ran well and maybe would have been more forgivable when the rates are lower. But when rates start going high and you don't put in the time on your property, now it's mismanaged and it's not cash flowing well and rates are higher. So you need an even higher cash flow requirements. So.
Just interesting. All the things you got to think about. I know we started this out talking about inflation and the reports that came out in June and the Fed fund meeting coming up, when they're going to set Fed funds rates again. So the Fed meeting coming up at the end of this month, which is when this drops, is going to be during this podcast. You got to look at everything. You got to look at this holistic picture. You can't just look at one sliver of it. You can't just say inflation numbers came down. We're going back to focus on that. Well, what's going on since then? Well, this is such volatile, and we've seen it. We want to look at the last year of the drops, increases in inflation. And the way they calculate inflation, I don't even want to get into that. That's just, and how they calculate employment numbers. I'm not going to get into that either.
Yeah, another one of those ones that came out, had a big effect on how the Fed looks at their rates, but also was, as our underwriter pointed out to us, probably mismanaged data that isn't going to be updated until next year. So it doesn't matter. They made the decisions on bad data, but now we still have to live with the effects of the bad data.
Take a look at the numbers, watch what's going on in the economy, but really focus on your local and regional markets to see what's actually being impacted there. Look at your consumers, understand you're a consumer, understand how it's impacting you, which means if you can absorb it because you're a higher income person, still pay attention to it because those are impacting everybody as well. You know, if you go in the store and you're like, my God, I can't believe I got to pay this for chicken. Everybody else that is renting from you or buying from you is paying that higher price too. So what's that eat it to? That eats into their savings, it eats their potential to pay rent, to buy products from you. Those things will have an impact because wages just aren't caught up with it.
It doesn't seem like they will anytime soon. I mean, they keep trying to raise minimum wage and stuff like that, but it doesn't seem like it's having any of the effect they're looking for, and inflation just kind of keeps steadily climbing. So we got some fun times ahead.
Yeah, don't even get me into the increasing minimum wage, because you increase minimum wage, which causes more inflation because you're just moving the bottom up and the bottom goes up over here in the cost, and they're at the same spot they were if you didn't increase wages. But that's a whole nother conversation.
We can revisit that another day. So I guess kind of the 2 words of wisdom I want to leave with, it's something we've been talking about. And as you can see, we've been diving into some more marketing and stuff for AI this year. And it's when times are a little rough, if you're in a position to, this is the time to double down and try to grow and try to bring more value or increase your cash flows, things like this, because people that are moving and finding deals in a market like this are the ones that will be set up for lots of success when the rate market does change and it does go to more favorable. Because if you're able to find a property that cash flows at a 7 or 8% rate, it's going to cash flow like a king when we get back down to even like a 5% rate. So don't be afraid to find deals right now. Don't let the doom and gloom get to you. Shoot us more questions. Shoot us more. What do you guys think about what's going on? Where do you think the rates might head? It's always interesting to hear what other people think. Give us a like, follow, subscribe. Anything else, Matt?
Drop us a DM.
There you go.
Guys, just looking forward to seeing what continues to happen this year. Not looking forward to it, but we will continue to watch what happens. We'll continue to watch what happens going forward this year and continue to update you our thoughts, what's going on in the marketplace, how this is impacting lending, your rates, the rate environment for you, and just continue to watch and follow us, guys. Look forward to seeing you on our next podcast, guys. Have a great day.
Thanks, guys. Appreciate it.